you have made over like 500 angel investment, right? So after first 100, what pattern did you see to see that change how you judge the deals?
Yeah, initially everything seemed excited and I had no idea what I was doing.
Where call yourself an anti-Silicon Valley investor, right? What are you giving up for being outside the ecosystem, or what are you gaining from that or losing from that?
Right. So every cycle has a lot of hype, and the hottest Silicon Valley startups have the Silicon Valley insiders that are going to dominate those rounds. So honestly, there would be adverse selection.
If you could change just one norm and belief in the early stage investing to make it more human and effective, what it could be?
Change one norm in venture investing.
Yes.
I wish there was more transparency.
So I will just give a little bit introduction. In the meantime, I will just cut down this part. So I'm basically from India. I was doing my doctorate in medicine from Philippines. Did that for like 2 years. Then I quit it due to financial constraint. Came back to India. Did a job in call center in 2016. Then I got an opportunity to come to Canada in 2017. Did my business management, and then I did a couple of kind of jobs, right? And after that, I started a D2C healthcare supplement brand based out of US and Canada. Ran that for like 1 year, and then I sold it to my partner. And then I started a neobank in fintech in India. So I started it, scaled it to a team of 18 people. We raised like a little bit amount of pre-seed round, but we could not raise like a larger round due to the dominance of UPI in India, right? So we were quite late. So after that, we sold our IP to another competitor and we got the exit. And after that, I started a podcast where I'm like building a media brand. We're also introducing the live shows, live streaming things in a couple of months, right? So we are planning for that and we're looking for partners, sponsors. So we are in plan of that, everything. So
Great.
This is my journey.
Well, I'm happy to be here with you.
Perfect. Thank you so much. And we will start with intro and then we can take it from there, okay?
So I'm David Mandel, a managing partner.
I will be we have the research, so we will give you an introduction and then we can take it from there, from your journey.
Tell me when you're ready.
Perfect. So will you rather take advice from someone who has only read about building companies or from someone who has actually built 4 of them? My guest today, David Mandel, spent 28 years building an existing 4 companies in insurance and finance before writing his first venture check. He made his over 500 angel investment and now runs emerging VC with a simple philosophy. Back founders who execute, not just talk. He is anti-Silicon Valley, anti-hype, has controversial views on AI, pre-seed investing, and why most startup fails. This conversation will challenge what you think about venture capital. David, welcome to Breakout Podcast.
Thanks for having me. As mentioned, I'm currently managing partner of Emerging Ventures Capital. I'm based in Los Angeles, California. We're a relatively small venture capital fund. We're on our 3rd fund and we invest in seed stage B2B tech startups.
Perfect. So you have spent 28 years as a founder before becoming a VC, right? What did that operator experience teach you about startup than a traditional VC career never could?
Yep. And yeah, that's a good question. And there seems to be 2 paths into venture capital. There's probably about half of us that are just like me, where they've been operators and then eventually got into angel investing and then made full transformation into starting a fund, which was my path, which I can get into a little more. And then there's, the other half that go the traditional route of, going through the business schools, becoming an intern or junior analyst at a big firm, working their way up and eventually winding up on an investment team at a big firm or partnering up eventually and starting their own smaller firm, or many times both. So there's both sides to it. Definitely, as an operator, it helps me understand what it takes to build a business and to run a business and, to hire, manage everything that has to do with it. I'm very skeptical of investors who literally never had a day job other than investing, let alone even try to build a business. I've seen too many that never really actually, in a sense, worked in their life other than in an investment firm. And I find it really hard to see how they can really understand what it takes to operate a business, let alone try to build one from scratch. And I don't think they have the perspective it takes. They know a lot about what they do, and they've had all the training on how to do the analysis that maybe I have not had, but I definitely know what it takes and what it feels like to start a business and run a business.
That actually makes sense because you have actually lived the chaos founders goes through, right? So that the actual founder experience you have gone through, so you understand what it takes for a founder to build such a large scale company, right?
Yeah,
And
yeah.
you also have a PhD in applied maths and brain wired for systems. And venture is very messy, emotional, and irrational, right? So how do you balance data with gut feeling in early stage investing?
Yeah, no, that's quite interesting. And just minor correction there, but I was in a doctorate program. I got the master's and eventually dropped out and did not stick around to get the doctorate and went into business instead. So I don't have, you can say I'm a PhD dropout. And uh, I did not ever get the doctorate, and I'm perfectly fine with that. But that was a different era. When I dropped out, that was 1991. It was just the early days. There was even no internet. It was the early days of AI in general. AI was not really happening, and I really wanted to work actually on AI. I was undergraduate. I was computer science and applied math, and graduate was just math. And I really wanted to do something in that field, and it just wasn't there. There wasn't anything there. And the academic path for mathematicians wasn't really there either. It was oversaturated. Professors just stay there literally until they die. They're tenured and they just stay and they don't retire. So there was an oversupply of math PhDs with really no interesting work. So unfortunately, bad timing for me then. Amazing time today to be in that field, obviously. And that's really how I got to where I am, because I went into business and I mostly ran underwriting businesses. So I had the analytical side. It was all about pricing and product, and it was all mostly B2B on both insurance and finance, about building models and a lot of automation and everything that we can do at the time with the tools we had. And that's really how I got excited to start investing. It was around 2011 and 2012 that I started to see in my day job. At the time, I was CEO of both a subprime auto lender and a large auto insurance underwriter, both in California. And we started to have some vendors come to us with really interesting tools. They started to come with us, for example, on the insurance side. Auto insurance claims is high volume business, but each claim is different. Different scenario, different everything, and a lot of it is still managed really old fashioned. It is digital, but it's almost no better than having a paper file because it's a lot of just free flowing notes. There wasn't a lot of structured data, and it was notes. And in the notes, they would have the interviews and information about doctors and lawyers and body shops and what's going on with the claim and what they're waiting for and everything else. And it was really hard to generate insight from that and analytics on that, other than when a claim was open, when the last notice was sent, all those kind of things, all the dates and stamps and all there. But other analytics were really hard. And then we started to have some vendors come to us. And I still remember this clearly today. And this was probably 2011. And they would say, hey, we can get you insight from your claims data. And it's like, this is all unstructured notes. And they're like, yes, give us a data dump of your unstructured notes and we'll give you insight. And it seemed too good to be true, but in fact, it was really working. So that was the early days of natural language processing and analytics on that. And that started to get me really interested. And it's like, okay, what I wanted to do 20 years earlier is now coming to fruition. They now can do some of the things I wanted to do back then. It's like I didn't even realize how far technology has come. I was focused on my field. I would go to insurance conferences, finance conferences. I would not really be in technology conferences. I would not be following what was going on in Silicon Valley. And after that, seeing some of those vendors come to us with really creative products, I was like, wow, I need to see where technology is. This is really exciting. This is what I want. I want to see where this is. I need to get involved in this. I need to do something here. I started spending a lot of time, initially slowly and then more and more intensely, attending, going around the country, going to technology conferences, different various events, getting involved with angel groups, starting to write some angel checks into some tech startups, because I was super excited at the time. Initially, everything looked amazing. Obviously, when you don't have a point of reference, and that's true for most new angel investors, every startup seems amazing when you haven't seen thousands of others. So you become more cynical over time. But initially, everything looked like, wow, this is crazy. I can't believe where everything is. I need to be in on this. And I got really excited. And it was actually to a point where I was enjoying more and more my time spent in angel investing and attending tech events and conferences, and less being in the office dealing with the day-to-day of operating businesses, where I say, the businesses are both kind of mature now. I love building them, even though we're making money. I don't necessarily love running them. Technology seems to be at an inflection point that's a once in a lifetime kind of opportunity to go back and work on what I really want to work on. And I made a deliberate choice to get out of the two businesses and become a full-time investor. So I got investment bankers, did a process, and within a couple of years, we exited both businesses. And I became a full-time angel investor. Then eventually by 2019, evolved also into enough other people that I ran into from my prior life, curious about what I'm doing. They haven't seen me around. I would be all excited about technology and investing. And they're like, oh, let me know next time you're writing a check. I want to, I'll come in with you. And enough people said that over the years where I say, let me make a small fund and I'll pull the money and we can write some bigger checks, have a little more discipline, have a team. And that's kind of how emerging ventures came around. In 2019, I finally broke down and made my first fund.
Oh, that's why you were also building analytical models before the data science was even a thing back in 1991. And you were basically saying the first wave was AI before we even called that, right?
Yeah, I mean, it wasn't AI, it is analytics. And to be fair, everyone was doing it. They were maybe not called data scientists, but they were analysts and actuaries and many other titles at every finance company, every financial institution, every insurance company has definitely a product team with analysts that do that kind of work.
And you have made over 500 angel investment, right? So after first 100, what pattern did you see to see that change how you judge the deals?
So yeah, initially everything seemed excited and I had no idea what I was doing. And I wrote a lot of checks into random startups. And over time, you start to develop a thesis and you start to see what you like. And my focus was always B2B because that's my background. I was, in a sense, in an enterprise environment. I understand SaaS for enterprise. I understand selling to enterprise because I was on the other side of it and what it takes, that whole process and procurement and all that. So enterprise SaaS always attracted me. And then a lot of other verticals attracted me that had to do with clean tech and ag tech. And I saw how, all these industries that haven't had a lot of improvement in decades are ripe for disruption and ripe for these new technologies to come in. So that thesis started to emerge as something that was interesting to me. And I started to kind of articulate my thesis as using emerging technologies to solve business challenges. And then over time, as you fast forward from there, I saw how hard it is to gain initial traction. And I eventually went away from the early pre-seed to further down to seed and now kind of to late seed. So my thesis has evolved over the years that way, with a focus on execution and on capital efficiency, which I didn't fully know how to articulate even until maybe 3 years ago. It's, that really what I'm looking for and what gets me excited is not only, that you're doing something interesting, but that you can execute. And it really comes down to execution. It comes down to a founding team that just gets shit done. They can build a product, they can sell the product, get the right customers to pay for the product, and do so in a short amount of time with a small budget, and just be efficient in the way they use their resources in general. And resources are time and money, and which comes down to also people, and it all works the other way around. So a small team doing a lot with a little. As an example, I give you two extremes. You see both of these extremes kind of every day. I see over 30 pitches a day at least now. And I wake up to tons of inbound and the deal flows all day long. But what I see that's an immediate turnoff is, say, a team of 15 people, all former executives from big companies. And they say, oh yeah, we've spent $6 million over the last 2 years building our team and developing the IP, and now we want to raise $10 million seed to commercialize it. I have absolutely no interest in that. That's an immediate delete. And on the other hand, I might see a team of 3 founders who in 6 months built an MVP, got 2 enterprise beta customers using it, and they did it all on a $500,000 budget. And now they're raising, let's say $1 million so that they can scale within the next 18 months to 2 million in ARR. That's efficient. It's like, okay, you're going to bring in more than you're going to spend, and you did everything until now very efficiently, and you're just a scrappy team that's gritty, and you'll figure it out no matter what comes your way. You're going to have obstacles, you're going to have the pivot. I don't even care what your business model is, what your pricing strategy is. It's not important. You'll figure that out. You're going to have to probably change it 10 times anyway. It doesn't matter, but they're the guys who will figure it out. They won't wait 2 years and have meetings about it. They'll just do it.
And that's such a clear contrast, right? Efficiency over the pedigree, and that grid shows like how fast the founders can move actually. So, what moment do you actually realize that the team has figured out DNA?
Yeah, they had to act like entrepreneurs. They had to be gritty, and that's really what matters. And they can't act like they're in a corporate environment. And both are possible. And how that got there was probably a slow evolution. Didn't know why I liked certain ones and didn't like others. It took me a long time to be able to articulate it the way I articulate it today. It wasn't clear to me in my head in a way that I can say it. It was more like I know what I like when I see it, but now I actually can articulate what it is. And it really does. And grit's an easy thing to throw around. It's like, oh, I look for grit, but I can actually articulate what I mean. And it's really just execution. They get a lot done with a little. They're efficient. Executing in a capital efficient manner is a way to articulate what that means. And that encapsulates everything and is a little more egalitarian. It really doesn't matter how you got there. I don't care what degrees you have or don't have, what school you went to, how you got there. If you can do it, that's impressive. If you can do it without having the pedigree, it's even more impressive in some way. You don't have the alumni network, you don't have the mentors, you don't have the family connections, but you got DoD contracts and you got big oil to give you a pilot, or you got Procter and Gamble to, it's like, I don't know how the hell you did that. I won't know how to do that. I'm kind of jealous that you can go out there and do that. I would be like, how do I reach someone at Procter and Gamble to even talk to me? When I'm a nobody, I have barely an MVP. Why would they want to talk to me? But there's some teams that somehow know how to do that and they can repeat it. It's not like just that they had a connection at one place because they interned there before. And I have to watch out for those. I got burnt on those several times where I got super excited because they had a great pilot, but it turns out that, one of the co-founders just had a connection there and they really, a year later, are still struggling on how to scale that. They don't have a good go-to-market strategy. So that's why I today make sure they have a repeatable, scalable sales process. So there's a go-to-market strategy that's working besides the early pilots. And I invest a little later than I used to because that's a hard leap to going from your first few customers to having a process to scale and continuously scale. Is a lot harder than it seems. They all think like, oh yeah, well I have these pilots, and once I prove these work, we're just going to go on LinkedIn and hire a team and do some outbound and go to some events. And they have like 5 different strategies of go to market. And you talk to them a year later and 2 years later, and they're still trying to figure it out. It's like, well, we went to some events and we got a lot of leads, but nothing really came out of it. We did some LinkedIn outbound, and we got some demos, but nothing's converting. We hired a sales team and we're paying them a base salary and some commission, and they're making a lot of calls, but we're not really closing deals. And so it's hard to figure that out. So I now look for those who have actually not only got some pilots, but can close the pilots, convert them to long-term contracts, and can repeat that. They have a go-to-market strategy that's actually working. I learned those lessons, honestly, the hard way by making investments in early teams that got me excited. I found that that's necessary, but it's not sufficient. You have to be able to execute. You have to be able to build an MVP quickly and cheaply and get early pilots on it. But you also have to be able to convert them to long-term contracts and then go the next step, which is build a go-to-market plan that actually works. Execute on the go-to-market plan, which is a whole different skill set and sometimes requires, bringing someone on that can do that, or having one of the co-founders have the skills to do that, which may not be the case if, say both co-founders are engineers. And, doing an enterprise sales process and the enterprise go-to-market is quite different. And, maybe they can be gritty enough to get on the phone and bug everyone or go to conferences and get a couple pilots, meet some VPs that get excited and want to help them and get some pilot, but it may not be the same as being able to actually get permanent enterprise contracts. And
Yeah,
now I
that's
understand that, but like even 3-4 years ago, I made some earlier investments into really early stage teams that got me excited without them having the second part.
no, that's such a very honest take. Like building and selling are two completely different muscles, right? So like it's a
And you've been
completely
there.
different thing. True, true. That's right. Like it's always been different, right? People combine it and then it's in confusion, right? And your fund is roughly 80% of applied tech and 20% of deep tech. Why do you believe you need to have both instead of choosing just the one lane?
Right. The 20% deep tech is for fun. The 80%, so I don't have to have both, but the 80% is the part that would, for stability. The 20% deep tech is higher risk, potentially higher reward, but it's things that personally interest me. So I take the luxury of being able to dedicate up to 20% of the fund to those higher risk kind of ventures where they don't have, their traction looks different, because on deep tech, they won't have revenue really. They are going to have different kind of traction. They might, and it's going to be a longer cycle. They're going to take, their traction might look like a pilot, a joint venture to develop something with a Fortune 100 company. Let's say it's a synthetic biology company. They're making some biodegradable plastic. Well, if Procter and Gamble is working with them, and I can talk to, like, say, the VP of R&D that they're working with there, and they say, yes, we looked at 100 different companies that are doing things like this, and we chose these guys to spend 3 months and try to build something with them. And we're putting 300,000 into this joint venture to sponsor this to see if it will go somewhere. It's like, okay, they're smarter than me when it comes to that. They're seeing everything in that material side. I'm not an expert on that, but that I'll bet on it for the fact that A, they got the attention of Procter and Gamble, so they know how to do that. And then B, Procter and Gamble selected them from hundreds of potential options probably. So it must be cutting edge, because to me, it can look like cutting edge because I don't know better. I don't know that there's maybe 20 other startups or more mature companies doing something similar, or maybe doing it even better, or maybe even further ahead. That's the risk I would have of adverse selection in that sense, going into a field where I'm not an expert. I just don't know what I don't know and what else is out there on the competitive. You can do some competitive analysis, but it's really hard to know what other startups are out there and where they are. But those who are the potential customers do know, because they're being hit up every day. So they've seen everything in that specific narrow field. And if they're saying they're choosing these guys, then that's good enough for me to say, okay, I like the team. You're telling me you like the product, then okay, I will write a small check into that, and that will be kind of in our deep tech bucket, because I know that it'll be a very long time before we see much happening there, and it's likely to go to zero, because it still has to pass a lot of, it's almost like investing in biotech, where you can have a lot of really good indication, but as it goes further down the process, it may fail somewhere. It may not go through all the validation. That's the same thing's true with most deep tech, where it either gets really good traction eventually and somebody buys it or licenses it or something and becomes a big hit, or it goes to zero. And it's the opposite of capital efficient usually later on. Later on, it's going to need a lot of money, but they can be capital efficient up front, where they took very little outside money. They were good at getting a lot of grant money and getting joint ventures, and the same thing where they're efficient up front. As we've done that, we've gone to some R&D coming out of university programs where they've spent many, many years as postdocs developing something in a university lab. Now they want to commercialize it. And again, there's some kind of Fortune 100 joint venture or military sponsorship or something where I said, I just did one where they just got $2.5 million from NASA. It's like, okay, NASA chose you for this project and they gave them, it's not pending. They actually granted them $2.5 million and they need to raise money. Part of the condition of the grant is they had a certain amount of time to raise money. So it's kind of a matching grant. They tell them, you go out and raise 1.5 million from the business world as independent investors, and then we'll give you 2.5 million. It's like, okay, so that's an efficient 1.5 million because they're getting 2.5 million from NASA, and NASA's going to be a customer for this. And it's like, awesome, okay. And it still may fail. It may go to zero. After NASA, we don't know what's next, but it seems like it gets them a long way there. And I wrote them a check into that one. It was really interesting and just something quite in the telecom industry, very innovative, a technology that can be very useful eventually for a lot of things. I won't get into any particulars on that at this point, but it's just really intriguing technology. Talked to a lot of people who were experts who did deep due diligence on it because I wasn't capable of that. To me, it sounded amazing as do a lot of other things, but this one got validated. There was others investing, co-investing. I was one of the smaller checks. There's some lead investors that did 8 months of due diligence on this and dug really deep. They were really excited. I was able to speak with them about it and understand why they're excited. And it's like, okay, I'll write a check and say this still may go to zero. It's not something that you're going to go out there and have sales tomorrow and be commercialized tomorrow. It's probably 5 years before the first commercial revenue comes in. So obviously, I'm not going to have a whole fund full of these. My LPs and myself as my own biggest LP will not be happy with that. Every one of these can go to zero and is not seeing any revenue tomorrow. But having a few of them, if we have 25, 30 investments per fund. If 5 of them are deep tech, that's okay. And if one of them hits big, even better. But at the end of the day, the portfolio will have stable returns from the other 20.
That's just such a smart investor filter, letting the industry giants validate the tech for you, right? Like NASA and everything. So it's just a very grounded way to look at the risk as well, like trusting the world validation, right, over the hype most of the startup creates.
Yeah, and
And
I don't have a choice because I don't have the ability to validate it otherwise. I'm not smart enough in any of those fields, and I don't have necessarily a network of people. I could hire experts, but it's just not, I'd rather them be able to go out there and prove that they can get those, they need to have traction. And traction on deep tech is proving that you can go out there and get potential customers excited about it. And it prevents me from investing in a lot of deep tech. It's a great filter for those who are earlier than that. When they come to me and they have this great supposed technology with all these patents and whatever, they say, now we're raising a round so we can go commercialize it. And it's like, okay, well, who's your pilot? Who's excited about this? Who's joint venturing with you to develop this? And it's like, oh, well, we're going to figure that out. We're going to hire someone to go get that after we raise this round. And I say no. And I hear that more often than I hear the other case. Probably 9 out of 10 deep tech startups that are at the kind of seed stage are pre-commercial agreements like that. And they're trying to use the money from the seed round to go do that rather than having done that already. And I like the ones who have done that already.
That's such a very humble take. You let the market validate what you cannot personally vet, right? They can go out and vet by themselves. And you call yourself an anti-Silicon Valley investor, right? What are you giving up for being outside the ecosystem, or what are you gaining from that or losing from that?
Right. So every cycle has a lot of hype, and the hottest Silicon Valley startups have the Silicon Valley insiders that are going to dominate those rounds. So honestly, there would be adverse selection. If they're coming to me, something's already wrong with them that, they didn't get funded by the insiders in Silicon Valley. And so that doesn't help me. That won't be a profile of a great fund. But really, the reason I started in the first place, if you take a step back, I'm in LA and I joined there's local angel groups out here and there's university programs here. And I was attending those, for over a decade now. But I would see time and time again that, the startups, so in LA, entertainment, direct-to-consumer brands, all that got a lot of attention. Even medical devices and biotech got a lot of attention down here. You have a lot of funds here that specialize in that. You have a lot of venture studios and other funds that focus on social and on direct-to-consumer brands and do a really good job on that. There wasn't very much attention to some of the deep tech and some of also the enterprise SaaS and everything else that I was interested. Some of that B2B stuff. I would be at these events and I would see these pitches here from local startup in that space, and they didn't get a lot of attention. And they were the ones that were kind of interesting to me. And I would talk to them, and they would be very happy to talk to me. And then I started to realize over time, and this was way back as an early angel investor, that first of all, that's what's interesting to me. And second of all, these are more interesting than the hype startups coming out of Silicon Valley. There's more diversity. Silicon Valley seemed like every batch, there was like 100 of the same thing coming out. And they all had, you can kind of tell that was Silicon Valley. They all had that same feel. And we had more diversity of the type of startups, more advanced in their where they are, much more eager to work with us and want us to be involved. So it just made sense to start working with those over time. It just became natural. And then the same thing was true in many other ecosystems. Same thing is true all around the country. And it's not necessarily not true in Northern California. We have a decent amount of Bay Area startups in our portfolio, but I'm also not specifically unicorn hunting. So one of the other big differences, if you take a bigger step back, Silicon Valley VCs, and especially a large seed fund needs to have great returns. So, they want really fast growing startups that are the potential next unicorns, and they want to be able to put a lot of money into them on round after round after round and help them grow really, really fast and either make it or die. And, they either become unicorns in a few years or they die. But they're going to do, a few $1 million seed round, and then they want to do probably a $20 million Series A and keep on going and going and going and write them big checks. That's not conducive as much for me with my smaller checks. And there's a whole bunch of startups that don't fit that mold. What I started to see is some really great startups that I like what they're doing. Let's say they're in ag tech. They're doing something really innovative for a certain type of farmers. They're doing something, and they've spent, maybe they have family that were farmers and they understand that area really well, and they went to engineering school, and all they want to do is come back and solve some problems that they saw on their parents' farm. And they built a solution and they validated it and they have some customers. But it's a slower growing company. It's less likely to go to zero. They already have, let's say, $500,000 in ARR. They have some contracts. They have a product out there. And, their own forecast is, they'll go from $500,000 to $1 million to maybe $2 million over 3 years. They show, potential exit for some big ag company or technology is going to buy them for like $200 or $300 million in maybe 5 to 10 years from now. Well, if we're investing at a 10 million valuation today, that's not a bad exit. Having a 20x after 5 years, I can live with that. Straight no to a Silicon Valley VC. The Silicon Valley VCs need that unicorn potential. They need a 100x minimum exit or they won't invest if there's not that potential. So they will say no. So when I'm saying I'm an anti-Silicon Valley VC, what I really mean is I'm not that I'm against companies based in the Silicon Valley, but I'm against the mentality of the Silicon Valley VC. The Silicon Valley VC is unicorn hunting and only unicorn hunting. And there's a large basket of great startups that are very unlikely to ever be unicorns. That's not their goal in life, but they are looking for a great exit for themselves and their investors. They are looking to be venture backed. So many of those are also not meant to be venture backed. And I spend a lot of time educating them that, venture capital is probably not the right road for you. And here's why, and we go through all that. But there's those in between that could be venture backed, but not by the Silicon Valley VCs because they don't fit that mold. They're not the next Facebook, because their own deck says, we can exit for 250 to 300 million in 5 years if we hit these metrics. And I look at that and say, yeah, you're right. And I like that possibility. I like your odds of getting there. And I don't mind going along for that ride. And I explained that to my LPs. And by the way, that turns off a lot of LPs when I tell them we're not unicorn hunting and that we're not doing what the Silicon Valley VCs are doing. Most potential LPs aren't interested in that because they were, at least back then in 2021. And so they are now maybe a different mindset. Maybe I'm a little vindicated, but back then everyone was unicorn hunting. When you tell them you're not, you're like, okay, why should I invest with you? I want access to the unicorns. If you're not going to get me that, I'm not going to get you access to those unicorns. That's not what I'm looking for. I may accidentally bump into a unicorn, but we're not hunting for them. And you won't find them in most of our kind of startups, but you will get a more stable return. Less of ours will fail. More of ours will have positive exits, and we can have a decent blended return. We're still going to target a fixed gross return, 3x net return to LPs when all said and done. And I still stand by that. So I think it's a win-win. I get to fund a lot of really good founders who are building something that is useful to the economy, useful to the world. I enable them, and while I get my investors a reasonable return on their capital that they're locking up with me, and to myself. So I think in that sense, it's a win-win. I'm providing a great service in a slightly underserved market. I'm obviously not the only one doing that, but it's a slightly underserved market. It's more of an angel investor mentality. Our fund is more of an angel fund where we're kind of investing more conservatively, not to lose, as opposed to investing just to win and just looking for unicorns.
That's quite a great point because you are not just chasing the unicorns, you are chasing who are building the real businesses. And that's such a refreshing lens from an investor point of view. Not every win has to be a unicorn. If they are getting a more positive impact, it's much
Right.
better.
Yeah.
And you look for.
And that's what I mean by anti-Silicon Valley, because Silicon Valley VC mindset is strictly unicorn hunting.
True. And you look for gritty, nimble founders, right? So in a 30-minute meeting before real adversity hit, how do you spot the two grit the founder has?
I suck at just looking at people and their idea and knowing if they're going to make it or not. So I have no magic wand for that, which is why I have to focus on execution. I can underwrite execution. I don't know how to underwrite a resume and an idea. And they need to prove to me that they can do it. So it's show me what you can do, not tell me what you want to do. And that's where I come in a little later stage, because I need them to show me that they were able to do all the things we talked about before about, build not only an MVP, but early traction in a capital efficient manner. And that's what gets me excited to say, okay, you got what it takes. And I'm happy to join this journey, but I can't come on the journey day one with your idea because I have no idea. It's like, build it, sell it, show me you know how to do that, show me people are willing to pay for it, show me you can do it in a gritty way, which means capital efficient really way, and just efficient in all way, capital efficient, time efficient, people efficient. Execute, get me excited with the execution, and I'm on board.
Perfect. So that's amazing. Like the execution beats like the ideas, right? And that's such an honest answer that you are betting on the proof, not just the personality of founders, right? And every founder's claims traction, right? What is the one question you use to separate the real momentum from the delusions?
Well, it's not necessarily a question, it's the proof. I really look, I get disappointed too often where pitch decks have amazing logos in them for their traction. And, when you start to dig in and you have your first, say, face-to-face with them and you go through the traction and say, tell me about, I see you have Pepsi on there as a logo. I see you have, whatever it might be, any other name a company that's a recognizable logo as a company. So tell me about that relationship. Is that with corporate? Is it a permanent? Is it a pilot? Give me the details. And then too often it unravels and it's not what you think, So the more you dig in and do due diligence, then you validate that it's either real and you get excited, or it turns out to be not so real. So traction, companies can claim, for example, even just in writing, they can put, like, say, ARR numbers, and well, that implies recurring revenue that's contracted. But some startups have some kind of other traction, and it's revenue, really more revenue than reoccurring. It's just some revenue they take in from some deal they've done, and they multiply that by 12. So they think, oh, last month we took in 50,000, so we're going to say we have 600,000 in ARR. Well, that's not quite true, because if you try to look for a contract and then, it all kind of falls apart, and that 600,000 ARR is really one-time revenue of 50,000 last month, and they have no idea where this month's revenue is going to come from, and whether it's transactional revenue or whatever. And then others, for example, you can go on and on and on. Due diligence tears up a lot of things. Founders often exaggerate or try to put good foot forward and not necessarily straight out lie, but they paint a rosy picture. And they might conflate market, so GMV, with revenue. And let's say it's a marketing tech, and they might be controlling $1 million worth of advertising, but it's not their revenue. They're maybe taking 5% as their fee to place the ads. The other 95% is really money passing through them that they're placing ads on behalf of the customers going to, let's say, to Google, right? And a very simple kind of idea. But if they're claiming, oh, we have $1 million in ARR, that's not really true. It's more like 50,000.
50.
Yeah, it's the 5% that's their revenue. That's your gross revenue. It's like, oh, well, we book that as gross revenue, and the other one's the cost of goods sold. It's like, okay, that's how you're booking it, but that's not really your ARR. And they get offended when you tell them that, but it's reality. It's they can book it, they want to book it, but it's not really their revenue. So the point is that it all has to get validated. It's not what so you ask the question, well, what question can I ask? It's really validating the claims, and so you can match apples to apples.
No, that's really a good point. Even ARR can be smoke if you don't dig down enough. And you predict that AI agent will be as big as the internet, but you also warn about the workflow and productivity, right? How can you be bullish and worried about the AI at the same time?
I knew we are going to get to AI somewhere here. That's it's a tricky conversation because it's moving so fast, and I'm not an absolute AI expert in any sense. I do see, though, lots of pitches, and obviously they're all AI now. I've been on every pitch event I go to or that I'm asked to be a judge on or whatever is like 95% AI startups. So I'm seeing AI all day, every day. What we all know, 2024 was kind of like all about generative AI. Every startup was doing generative AI, and there are hundreds of them for every vertical of every industry when it came to the B2B side. I'm not even looking at the consumer stuff. But on the B2B side, there was hundreds for lawyers doing different parts, trying to automate, hundreds for accountants, hundreds for doctors, for dentists, for whatever. And it's just, a free for all everywhere because it was so easy to spin them up. So everyone was doing that, and they were somehow raising money, and they were getting early traction too. It was amazing because everyone wanted to try AI. So if you went to a dentist and say, I have AI for dentists, you don't have to try to figure out ChatGPT. They're like, sure, I'll sign up. Why not? Right? And it was relatively cheap. A lot of times they'll give them, like a $50 a month membership to try it. It's like, single user, and they didn't have to integrate or anything. It's like, okay. So they would have great early traction. It's like, we have 100 customers, all B2B customers. That sounds amazing. But, are they going to keep it? They're all, because they're basically, you got a bunch of dentists that were curious to play with your new toy. It's not worth $20 million, which was also, I didn't invest in any of those because I saw that big disconnect. Move on to 2020, and it was the year of the agentic AI.
Yes.
And I wrote a blog post about that, I think in June, after YC put out a call in their batch for agentic AI. And then I was looking at the graduating batch, and it was like 60% agentic AI B2B for different. So they all switched from generative AI to agentic AI. And that's great. That's more useful. But still very, very early. And it seems like most of these are just cute little products for now that were quickly put together and not necessarily companies. And will some survive? Maybe. Will some get bought out by the verticals for their industries? Maybe. But most will probably be displaced by the foundational model companies providing these built in. So, which is happening already. Like everyone's now using, the cloud code to do instead of hundreds of other startups that were doing that. You don't need these startups when you can get it directly, from Google or Anthropic or OpenAI or whatever. So I have not invested in any of those for that same reason. And it's kind of frustrating being an investor in this era because I'm sitting here and 95% of what I see seems super interesting, and they have the traction and they have everything. And yet I don't want to invest because I just have this feeling like 1999 all over again. And I'm old enough to have been around then.
That's so true.
So I'm just watching. So I'm very excited. I know we're all going to have personal assistant AIs of some sort. We're going to have, I'm excited for where the future is going to, and it's kind of here now. I'm on my third Tesla in 13 years. I've watched the evolution of self-driving cars using these tools, but it's changing so fast that I'm really hesitant to invest in any of these genres right now. And I think the new moat is probably data, proprietary data. So the only time I get excited enough to actually want to meet with founders of AI startup is when they have proprietary data and they locked it in contractually somehow. So, if you're doing something using, and you have, your moat is not that you're first to your customers and you have their data, because that's not really a moat. But if you have, let's say you're doing something in law, but you got exclusive licensing to a whole database of case law, which I don't even think is possible. I think those are all public. Let's just say you had exclusive access to something, this large database. Maybe you partner with Reuters and you have an exclusive partnership with Reuters to use their data and go to their customers. And I would be interested because that cannot be replicated. Otherwise, you use some tools and you built AI agent in 3 months with a co-founder part-time, and you got a few customers to use it. It's like, okay, but what's stopping, say, my evil twin, hypothetically, from going out there and, getting 2 really bright Stanford grads or just students and say, here, take a semester off. Here's $1 million. Build this for me. Could they build it? And if the answer is yes, then why are you worth $20 million? If I can build this for, if someone else can build this, then it wouldn't cost more than $1 million. Probably wouldn't even cost $250,000. If I can build this, why would I invest in you? That's the question that I cannot get a good answer to 99% of the time with today's startups. I don't see a moat. I don't see anything proprietary. Once in a while you do. Once in a while someone has proprietary data or really proprietary experience. where there's a whole team that maybe have spent a couple decades together in a certain field and have every connection in that industry. There was one I did invest in that was using AI, but it was providing the dashboard analytics for schools, which is a boring, and it's really, really hard to sell to schools.
That's so true.
And school districts in the United States, public school districts, are probably one of the hardest customers to sell to. They have very tight budgets. They have a once a year kind of cycle when they have put something in the budget. That's a whole different animal. And you either know how to sell to them or not. And it takes probably a lifetime to learn. I saw a team, and this was through an angel group locally, and there was a great team that they've done this 3 times. They've built something in that space. Took them a long time the first time to figure out how to sell to schools. Eventually got private equity backing. So it started out bootstrapped. They eventually got private equity. They grew it. Then they exited. It was a roll up of EdTech by private equity. They exited, they did it again, something else. And by then they had their base. They had the relationships. They know how to sell to schools. They know how to talk to schools. They know what schools want. They understand. And now they're coming back for the 3rd time, doing something with AI specifically for schools in a very specific niche, integrating with very specific systems that they know that those schools use. They know the technology. They know the people. They know everything. So I'm betting on that. And they already had, within the first 6 months, they had like 400,000 in real ARR, actual contracted ARR. And, that's the exception to say, okay, that is proprietary. 2 kids out of Stanford cannot replicate that. They can build the technology better than you did. Your technology is not that amazing, but they don't know how to get into the schools. And the schools won't trust them. The schools trust you, and you know exactly how to speak their language, and you know exactly what they want. They know how to make a product that they will want to use, that they will get excited about. It's not what you want, it's what you know they want. And they built this product based on interviewing their existing customers. They went out there and saying, what do you really need? What other pain do you have today that I can solve for you, that our other company that I just left isn't solving for you? What do you wish they had? And when they found out what that pain point was, they went and built that product. And it's like, okay. So that's an example where I did bet on it. AI is useful. You can have a moat if you have either unique data or somehow unique access to a really niche industry. And again, that's one that was a lower valuation because it's not a potential unicorn. It's in a boring, slow-moving industry. Silicon Valley VCs will not invest in that. It's not sexy. It does not have unicorn potential. Their own estimate, and all their prior exits were like 20 to 50x exits. And their own estimate of this is like they're looking for like a 20x exit in 3 years. They're looking for a quick exit. They're like doing this one last time. They're ready, kind of like our age. They're in their 50s, want to have one last exit. They just want to do this one last thing for the industry. And they're looking for like a minimum 20x exit in 3 years. They just want to build it up, get to a certain point, and then get it off to get rolled into some other PE roll-up somewhere, or some of the large platforms buy them and they move on, and maybe they support it for a couple of years. And it's like, I'm okay with that. Bless you.
Sorry.
So anyway, we've been going for nearly an hour. I know I've been rambling on a lot. I don't know if there's any last set of questions you want to get to, or
Yeah, that's such a great example. Experience itself became their mode for the team, right? And venture that is back for companies avoiding the downrights they have raised from the 2021 peak, right? As an equity investor, how worried are you about the debt? Because it just delays the pains and drains value from the founders and early believers, right?
if you're talking about valuations.
Yes.
And yeah, the 2021 peak created a lot of havoc. It hurt our portfolio. Our fund 2 was a 2021 vintage. They're still recovering now. A lot of those that raised seed rounds at high valuations struggled for many, many years to try to raise a Series A. Some were stubborn and refused to do a down round and actually went out of business for running out of cash. And by the time they decided that, to do something, it was too late. Those who were successful, either had amazing traction and were able to grow out of it, or, wind up doing a Series A that wasn't even necessarily much of a markup. Maybe it was flat, maybe it was a small markup, and then eventually it all resets and they move on. They raise a Series B, Series C, and they grow. Now the market reset. There's a new normal, and some of the ones who raised in 21 at high valuations will fail, and some raise down rounds and move on. And it is what it is. It's part of the cycle.
That's a great closer. Like, it ties everything back to the purpose. So in the long run, emerging VC will be judged by the founders you backed and the ecosystem you helped shape, right? Not just the returns you have made. If you could change just one norm and belief in the early stage investing to make it more human and effective, what it could be?
Change one norm in venture investing.
Yes.
I wish there was more transparency. It's
No,
still
that's
it's a very opaque industry. There's as much as there's databases like Crunchbase and PitchBook, and it's still not good transparency in this industry. It's hard for founders to apply to the right investors at the right stage for the right funding. And a lot of people were trying to solve that. There's a lot of like both traditional and AI startups trying to be matchmakers and provide a smoother experience, but it's still not there. It doesn't exist. There's no unified data sets. Public markets are transparent, super transparent. And the public markets are almost the exact opposite. And there needs to be something closer to what the public markets are for private markets. I don't know what the solution looks like. I know a lot of people are working on it. I think even NASDAQ has a NASDAQ private markets kind of initiative they're working on. It'll be interesting to see where it winds up, but it's not there yet today. And that makes it very inefficient for investors to find the right startups to invest in and for startups to find the right investors.
Yeah, it really is, because like even with all this data platform, so much still happen behind the closed doors, right? So there need to be something for private equity market to be more open platform for data for startups and VC. So that's David Mandel, operator turned investor, cutting through the noise. If this change how you think about building or investing, share it with someone who needs to hear it. Check out emerging.vc and check out davidmandel.blog for more updates from David Mandel. Subscribe if you haven't already, and more conversations are coming your way. Thank you for listening to Breakout Podcast. Keep building and keep breaking out.